Hello everyone, welcome back to Invest with Dan. If you are new here, my name is Dan and this channel is about one thing: real money, real decisions, real life. Today's topic is something I feel very strongly about because I have seen too many people wait their whole lives to start investing, thinking they need to be rich first, and that is simply not true. Whether you have $10 or $10,000, there's a place for you in this conversation. So sit down, pay attention, and let's get into it.
There is a lie that has kept millions of people financially stuck for their entire lives. And the lie sounds completely reasonable. It sounds logical. It even sounds like wisdom. The lie is this: I will start investing when I have more money. Most people have said this. I understand why. Because when you hear stories about building portfolios and buying stocks and generating passive income, your mind jumps to big numbers. And you look at what you have, maybe $50, maybe $100, and your brain says, that is too small. That cannot do anything meaningful. But here is what your brain got wrong. It is not comparing your money to what investing actually requires. It is comparing your money to what investing looks like in your imagination. And those two things are completely different. The truth, backed by decades of financial data from markets all over the world, is that the most important factor in building wealth through investing is not how much you start with, it is when you start. And the second most important factor is not how much you invest at once, it is how consistently you invest over time. These two things, time and consistency, are available to every single person right now, rich or not yet rich, employed or still building, living in America, Europe, Asia, Africa, anywhere in the world. The playing field is more equal than you think. A stock is not a lottery ticket. A stock is not a gambling chip. A stock is partial ownership in a real company. When you buy a share of any company anywhere in the world, you are buying a small piece of that business. You become a part owner. And when that business performs well, when revenue grows, when profit increases, the value of your ownership grows with it. In the short term, stock prices move on emotion, fear, greed, news, speculation, panic. But in the long term, over years and decades, stock prices follow one thing: business performance. That is what you are doing when you invest. Even with $50, even with $100, you are not gambling. You are becoming an owner. Now let us talk about the concept that separates people who build wealth from people who wonder why they never did. Compound interest. What is compound interest? When you invest money and it earns a return, you now have more money than you started with. Next time, you earn returns not just on your original amount but on your original amount, plus the returns you already earned. Your money earns returns. Then those returns earn returns. Then those returns earn more returns. Over time, this creates a snowball, slow at first, then unstoppable. Let me give you a real number: $50, not 5,000, not 50,000, just $50 invested every single month into the S&P 500, a basket of the 500 largest companies in the United States. If you had started doing that 20 years ago, $50 a month every month without stopping, do you know what that would be worth today? Over $12,000. $50 a month. That is less than $2 a day, one less takeout meal a week, one less forgotten subscription. But I know what some of you are thinking. What is the assurance that I will still be alive in 20 years? I understand that thought. Life is uncertain. But let me ask you something back. What if you are alive in 20 years? What if you are alive in 30? What about your children? What about the family you promised a better life? The question is not whether you will be alive to see the result. The question is, are you going to show up for the version of yourself that might be? And this works everywhere in the world. In the United States, someone investing $100 a month from their mid-20s, without panicking during market crashes, would retire with several $100,000, not because they were rich, because they were consistent. In the United Kingdom, India, across Africa, Southeast Asia, wherever investment apps now allow you to buy shares as easily as ordering food, the same principle applies. The barrier to entry has never been lower. The only thing standing between most people and investing is the belief that they cannot start yet. Now here is something critical, because I do not want anyone thinking investing is just throwing money at the market and hoping for the best. Money without knowledge is dangerous. You can start small today and grow it significantly over time, that is true. But starting with money and zero knowledge, that is how people lose everything. The difference between disciplined investing and gambling with optimism is real. Before putting money into any company or fund, ask yourself 5 questions. 1. Has this company been growing consistently for the last 3 to 5 years? 2. Is the business generating real cash? Not just accounting profit on paper, but actual money flowing in. 3. Is the debt manageable? A company drowning in debt is one bad year away from serious trouble. 4. Is the valuation reasonable? Are you paying a fair price or buying something overpriced because everyone is excited right now? 5. Do I actually understand what this business does? If you cannot answer those 5 questions, wait, learn first, then invest, and follow these protection rules. Build an emergency fund first. 3 to 6 months of your living expenses, sitting safe and accessible. Never invest money you might need urgently. Never put more than 20 to 25% into any single stock. Diversification is not just a finance word, it is protection. Never invest borrowed money. Interest on a loan does not wait for markets to recover. Debt plus volatility destroys discipline. Never chase hype when everyone is talking about a stock. Smart money is usually already preparing to exit. The market is not your enemy. Lack of structure is your enemy. Let me give you the habits that grow and protect wealth over the long term. Think in years, not weeks. The biggest mistake new investors make is checking their portfolio every day and reacting to every price movement. Prices move on emotion in the short term, on fundamentals in the long term. If you have done your research and chosen well, sit down and let time do the work. Reinvest your dividends. When a company pays you dividends, which is a portion of profit paid to shareholders, do not spend it. Put it back in. Let it compound. Let it add to your snowball. Trim when a single position gets too large. If one stock has grown to dominate your portfolio, sell a portion, lock in some profit, and rebalance. Profit taking is not weakness, it is discipline. Review your portfolio every 6 months, not every day, not every week. Every 6 months, check, adjust, and continue. Keep learning. Understand how companies make money. Learn what a P/E ratio means. A P/E ratio tells you how much you are paying for every dollar of a company's earnings. A high P/E means strong future growth is expected. A low P/E could mean the stock is undervalued or that the market sees problems. Never use it alone, compare it to the company's own history and its sector peers. Return on equity tells you how efficiently a company uses shareholder money to generate profit. Above 20% is strong. The higher and more consistent, the better. Always check cash flow too. Profit can be manipulated on paper. Cash flow rarely lies. Make sure the real cash coming in from the business is close to or higher than the profit being reported. These are not complicated ideas, but they are the difference between an investor building real wealth and one blaming the market for losses that came from a lack of structure. So how do you actually start? Right now, today, with whatever you have. Step 1. Decide on an amount. No matter how small, $10, $50, whatever you can commit to every single month. without disrupting your basic needs. Consistency matters more than size. Step 2. Choose a licensed platform. In your country, in the US, Fidelity, Vanguard, Charles Schwab. In the UK, Vanguard UK or Freetrade. In other countries, local licensed brokerage apps or global platforms like Interactive Brokers. Verify that any platform you use is regulated. Never send money to an unregulated service. Step 3. Start with index funds. If you are a beginner, an index fund tracks a whole market, like the S&P 500, so instead of picking individual companies, you own a small piece of hundreds at once. Lower risk, proven long-term returns. Perfect starting point. Step 4. Automate it if you can. Every month same amount goes in. You do not wait to feel ready. You do not wait for the market to look perfect. You go in and you stay in. Step 5. Keep learning. Read about what you invest in. Understand how the businesses you own make money, because the more you know, the better and more confident your decisions become. Now let me leave you with this thought. The person who starts with $50 today and stays consistent for 20 years will almost always outperform the person who waits for the perfect moment with more money. Time in the market beats timing the market every single time. You do not need to be rich to start. You need to start to get rich. Compound interest does not care where you are from. It does not care what currency you use. It only cares about one thing. Did you show up consistently?
And that is a wrap on today's video. I hope this opened your eyes, because I genuinely believe that anyone, anywhere in the world can start building wealth today. Not tomorrow, not when the time is right, but today. If this video added value to your life, please like it, share it with someone who needs it, and subscribe if you have not already. I put out content almost every day designed to help you think better about money and make smarter decisions. I'll see you in the next one. Take care of yourself and start building.